If you're serious about building lasting wealth, you need to understand one fundamental truth. The best investment isn't a get-rich-quick scheme. It's patience combined with the right stocks that reward you month after month, year after year. Today, I'm breaking down 3 exceptional high-yield dividend stocks that are designed to be held forever. These aren't flashy growth plays. These are the foundational pillars of a real wealth-building strategy. If you're ready to learn how to generate passive income that actually compounds over decades, please subscribe to this channel so you don't miss the insights that could transform your financial future. Let's start with what makes a dividend stock worth holding forever. A truly exceptional dividend stock does 3 things. First, it generates cash returns to shareholders consistently, regardless of market conditions. Second, it has a business model so durable and reliable that it can maintain or even increase these payments through economic cycles. And third, it's been proven over many years, sometimes decades, to create real wealth for patient investors. The first stock on our list is Johnson & Johnson. If you've never owned a share of J&J, you might be surprised to learn that this company has increased its dividend payout for 60 consecutive years. That's not a typo. 60 years of continuous increases. This isn't a company trying to prove itself. This is a company with a fortress balance sheet, a diversified portfolio spanning pharmaceuticals, medical devices, and consumer health, and management that views shareholders as partners in a long-term venture. What makes Johnson & Johnson different? The answer is consistency. In any given year, yes, the stock price might fluctuate. The market might worry about a particular drug approval or a lawsuit. But the dividend check arrives, and it's higher than it was the year before. For someone buying and holding, this creates a mathematically powerful outcome. Your initial yield gets higher every single year without you selling a single share. A 2% yield in year 1 becomes 2.3% in year 5, then 2.6% in year 10, all on your original purchase price. The current yield sits around 2 to 2.5%, which might not sound thrilling until you understand the power of compounding and consistency. Most investors chase stocks with 8 or 9% yields, only to watch those yields collapse when the company cuts the dividend. Johnson & Johnson rewards patience. It rewards people who understand that boring, consistent, and reliable beats exciting and unpredictable every single time. The second stock that belongs in a forever portfolio is Procter & Gamble. Procter & Gamble is the company behind brands you use every single day: Tide, Gillette, Pampers, Crest, Olay, and dozens of others. The genius of Procter & Gamble is that its products sell regardless of economic conditions. Whether the economy is booming or people are pinching pennies, they still brush their teeth, they still do laundry, they still use shampoo. This defensibility is everything when you're building a forever holding. Procter & Gamble has raised its dividend for 66 consecutive years. Yes, you read that right. 66 years. The company generates enormous free cash flow from its portfolio of essential consumer products, and management has committed that a significant portion of that cash goes directly to shareholders. The current yield hovers around 2.5%, similar to Johnson & Johnson, but again, this yield is practically guaranteed to increase annually. What separates Procter & Gamble from many other dividend stocks is the quality of its earnings. The company doesn't rely on cheap debt or financial engineering to fund its dividend. It's generated from real operations, real sales, real profit. This means the dividend is incredibly safe. You could have bought Procter & Gamble in 2007, right before the financial crisis, and every single month you would have received your dividend check. And it would have been higher in 2008 than it was in 2007. The third stock deserving a spot in your forever portfolio is Coca-Cola. Coca-Cola operates in a unique category. It's a global consumer staples company with network effects that are almost impossible to replicate. The company's products are sold in more than 200 countries. Coca-Cola doesn't just sell beverages, it sells a distribution network, brand recognition, and access to billions of consumers. Coca-Cola has increased its dividend for 60 consecutive years, matching Johnson & Johnson. The current yield sits around 3%, which is notably higher than J&J or Procter & Gamble, making it particularly attractive for income-focused investors. The company generates extraordinary free cash flow, and despite returning significant amounts to shareholders, it maintains a strong balance sheet and continues investing in innovation. One critical insight about Coca-Cola that separates it from the other two: the international exposure. When you own Coca-Cola, You're getting exposure to emerging market growth at a de facto discount. A growing middle class in India, Vietnam, and Indonesia is drinking more Coca-Cola products. This geographic diversification is a hidden strength. Now, let's talk about why these three stocks deserve to be held forever, because that's where most investors miss the boat. You see this all over the internet. People chase yield. They hunt for stocks paying 5%, 6%, 7%, and then the dividend gets cut, the stock crashes, and they lose money. That's not a dividend strategy. That's speculation dressed up in income language. A forever hold means you're buying a piece of a business that is so fundamentally sound that you genuinely don't care about the stock price on any given day. You care about the dividend. You care about the rate at which that dividend grows. And you care about sleeping soundly, knowing that the underlying business isn't going to implode. All three of these stocks meet that criteria. They've been tested through recessions, through wars, through pandemics, through technological disruption, and they've come out stronger. The math of forever holding is extraordinary when you let it compound. Imagine you invested $10,000 in Coca-Cola 10 years ago at roughly $45 per share. You'd own roughly 222 shares. The dividend has grown from about $1.46 per share to roughly $2.20 per share. If you'd reinvested those dividends by purchasing more shares, you wouldn't just have 222 shares anymore. You'd have significantly more, purchased at varying prices over a decade. Your dividend income would be higher. Your principal would likely be higher. And this happened without you checking the stock price every single day or making a single trade. That's the power of forever holding. You're not timing the market. You're not trying to catch bottoms or sell at tops. You're participating in a business that is fundamentally improving itself every single year. The dividend grows. More shares get purchased with reinvested dividends. The dividend grows on a larger base. The cycle repeats. Now here's something critical that separates truly successful dividend investors from everyone else. You need to approach these stocks with the right mindset. These aren't lottery tickets. These aren't speculations. These are business ownership stakes in companies with century-long track records of success. When you buy Johnson & Johnson, you're not hoping for a stock price spike. You're buying a dividend stream that increases reliably. If the stock price drops, that's not a tragedy. That's an opportunity to buy more of the same reliable dividend stream at a cheaper price. This mindset shift is harder than it sounds, because it goes against every instinct the market is training you to have. The financial media wants you focused on price momentum, on quarterly earnings beats, on who's buying and who's selling. But the investors who actually build generational wealth, they're ignoring that noise. They're focused on cash returns to shareholders and the durability of those cash returns. Let me be direct about the challenges you'll face holding these stocks forever. First, you'll feel bored. Other people will be making money on meme stocks or crypto or the latest hot technology company. Your Coca-Cola stock will be climbing slowly and steadily. That boredom is actually a sign you're doing it right. The stocks that feel exciting to own are often the ones that crash spectacularly. Second, you'll face questions about valuation. There will be periods when Coca-Cola or Procter & Gamble or Johnson & Johnson feel expensive relative to the broader market. Investors will question whether the dividend yield is adequate compensation for the risk. This is where discipline matters. If you're holding these stocks forever, and the dividend is growing consistently, valuation concerns matter far less than they would for a trader. Third, you might worry about disruption. Will energy drinks cannibalize Coca-Cola? Will direct-to-consumer brands hurt Procter & Gamble? Will new pharmaceutical competitors challenge Johnson & Johnson? These are real questions, but here's the thing. These companies have the scale, the capital, and the management talent to navigate disruption. Procter & Gamble has adapted its portfolio as consumer preferences shifted. Coca-Cola has expanded into water, juice, sports drinks, and beyond. Johnson & Johnson invests billions in research and development to stay ahead of the curve. These are adaptive, resilient businesses. So let me give you a practical framework for implementing this strategy. First, decide how much of your investable capital you want to allocate to dividend growth stocks. A common approach for long-term investors is 15 to 30% of a diversified portfolio. These aren't your entire wealth strategy. They're a core component that generates reliable income. Second, start with purchases in whatever size makes sense for you. You don't need $10,000 to get started. Even if you can only invest a few $100s, that's legitimate. The key is consistency. Consider setting up monthly purchases through a brokerage that allows it. This ensures your dollar cost averaging over time, removing the pressure of trying to time the perfect entry. Third, reinvest all dividends back into additional shares. Most brokerages offer dividend reinvestment plans, often called DRIPs. This is where the magic happens. You're not taking the dividend as cash and spending it. You're using it to buy more shares of the same company. Over decades, this creates exponential growth in both your share count and your dividend income. Fourth, ignore short-term price movements. If the stock drops 20%, that's not a reason to panic sell. It's often a reason to buy more at a cheaper price. If the stock rises 50%, that's wonderful, but it doesn't change the fundamental thesis. You're holding this forever. Price gyrations are irrelevant. Fifth, check in annually on these holdings, but not too frequently. Review the dividend history. Has it increased? Are the company's fundamentals still sound? Are there legitimate concerns about the business model? If the answer to the first two questions is yes and the third is no, hold. If something has fundamentally changed, reassess. But for most investors, most of the time, the right decision is to sit still. Let me address one more question that comes up constantly. Aren't these stocks too expensive right now? That's the eternal question in investing. And here's the answer. If you're planning to hold these stocks forever, the entry price matters far less than most people think. Yes, buying at a lower price is better than buying at a higher price. But if you're holding for 30 or 40 years, and the dividend grows consistently, the entry point becomes almost irrelevant. The dividend growth compounds, the share growth compounds, time compounds. Consider this. In 2000, Coca-Cola traded around $40 per share, with a dividend yield under 2%. It felt expensive to many investors. But for someone who bought then and held, the dividend has grown so dramatically that the original entry price is almost meaningless. They're now collecting more in annual dividends than their original investment. Final thought on this strategy. Building wealth through dividend stocks requires something that modern culture doesn't celebrate enough: patience. It requires the ability to sit still while others chase excitement. It requires confidence that you don't need to beat the market every year. You just need to participate in reliable, growing cash returns from genuinely exceptional businesses. Johnson & Johnson, Procter & Gamble, and Coca-Cola have proven they can deliver that over 6 decades. There's every reason to believe they'll continue. If this video added value to your investing journey, please like it. I put significant research into breaking down these 3 stocks and explaining the psychology of forever holding. And if you haven't subscribed yet, this is the moment. Subscribe to this channel so you get the next video on dividend strategy before anyone else. Finally, I'd love to know in the comments, which of these 3 stocks are you most interested in and why? Or if you already own them, how long have you been holding? Your perspective and experience matter in this community. Thanks for watching, and I'll see you in the next one.